Welcome to the long-awaited April's special topic monthly webinar. We'll be covering some very exciting content today that many of our clients have been eagerly anticipating. With tax season behind us, we're back on the ball. Just a reminder that this webinar does not constitute advice and that webinar participants are encouraged to contact us at OTA Tax Pros to schedule a consultation. It's no secret we're huge fans of the self-directed solo 401k here at OTA Tax Pros. Most of our clients who set up entities with us also set up a connected self-directed 401k to leverage their tremendous benefits. Today, I wanted to take a few minutes to discuss some of the more advanced techniques that our clients are employing inside their solo 401ks. We'll cover investing in real estate, investing in precious metals, 401k Roth Conversions, joint spousal contributions, and participant loans. And after today's webinar, stick around for a monthly bonus material where you might find out how to get a free LLC. My name is Thomas Jones. I am the tax manager here at OTA Tax Pros. And at OTA Tax Pros, as a division of Online Trading Academy, we offer specialized one-on-one services for OTA students, ranging from forming trading and real estate entities to setting up self-directed retirement plans and bookkeeping to preparing taxes for students from all walks of life. To get started, you can schedule a consultation with us where we'll lay out a game plan to help you reduce risks and save taxes. Our unofficial motto at OTA Tax Pros is simple does not necessarily equal savings. Unfortunately, as in the rest of the world of finance, solo 401ks are ambiguous and frequently complex vehicles. Perhaps the most common 401k real estate transaction we see our students use is buy and hold, both single and multifamily rentals. Often these properties are acquired with non-recourse mortgages. I'll explain this in a little bit more in a moment. Because IRS rules prohibit retirement assets from being collateralized by creditors, traditional financing is usually not available. However, some banks will do non-recourse mortgages which will only collateralize the property itself without any recourse to the 401k itself in case of default. Some people use their 401k to invest in fix and flip or wholesale properties. You'll need to be careful to not engage in prohibited transactions. Principally, you cannot invest in a flipping business you profit from or flip a home you will personally live in. More often, investors will use their 401k funds to invest in others' flipping businesses. This can be in the form of a hard money loan. Hard money loans are used by flippers to acquire distressed properties and finance repair costs. Typical fees are 2 points up front and 12% interest. Uncommon but not heard of, you can also use your 401k to purchase tax liens. When an owner falls behind in paying their property taxes, a county may place a tax lien on the property. You can often purchase these tax liens from the county at auction. If the owner pays, you keep the taxes plus penalties and interest. If the owner defaults, you keep their property. So those are just some of the real estate transactions that we've seen OTA students use to invest their 401k assets. So here's a look at some of the rules that govern investing in your solo 401k. Opportunities to invest in real estate are really only limited by the capital in the 401k and the prohibited transaction rule. Before you get excited daydreaming about financing your next house with your retirement, you need to know that the IRS penalizes retirement plans that engage in prohibited transactions with plan owners. That penalty can be as high as 100% of the economic gain derived from the transaction. So, while you can purchase a Subway franchise, invest in a fix and flip project, and sell properties, you cannot personally profit from any of these transactions, only the 401k. This means you cannot work in or participate in any business invested in by the 401k. You cannot sell to, buy from, or live in any property that the 401k invests in and owns. And this rule extends to listed family members and certain friends too. Also, because IRS rules prohibit retirement assets from being collateralized by creditors, traditional financing is usually not available. However, some banks will do non-recourse mortgages which only collateralize the property itself without any recourse to the 401k itself in case of default. At OTA Tax Pros, we keep a list of non-recourse lenders which our 401k clients can use to pursue this type of leverage. Most of these lenders only loan up to 50% LTV or loan to value, although some may go as high as 75%. We also often hear that retirement plans can't invest in futures or forex or short the market. This relates to the margin required to trade such assets. Since margin requirements vary by institution, ask if they allow retirement plans to trade on margin and short the market. Because the margin would be non-recourse, the institution may limit how much margin they provide. Whether you want something tangible to invest in, or you think the economy is going to crash, maybe you know the government is watching you, or you just like that it's shiny, gold can be a very attractive investment. If precious metal suits your fancy, a 401k could be the ideal vehicle to invest in some. Just note, there's still some rules to follow. Some of our students who invest in gold, silver, or platinum, which can be owned by the 401k, follow these rules. Only certain platinum, palladium, gold, or silver can be owned by a 401k. Bullion bars and rounds must meet minimum fineness requirements and be produced by an approved refinery or mint. So you can't just go buy any gold. Also, collector's coins are not allowed because they're considered collectibles. Collectibles are not allowed to be owned by retirement plans. For those looking for discretion and privacy, keep in mind that whenever you trade or sell gold and silver back to a dealer, the dealer has a reporting requirement to issue you a 1099 miscellaneous at the end of the year if the transaction is over a certain number of ounces, and this doesn't get excluded for 401k plans. Lastly, plan assets need to be held by the plan trustee, not the plan owner. The lines become blurred in cases where the 401k owner is also the trustee, but the principle of the rule is assets should not be personally or privately stored by the individual owner. So we'd recommend keeping 401k precious metals in a safe deposit box at the institution you also have your 401k checking account. Not to mention, the bank has an insurance policy that covers you if they get robbed. Storing gold bars under your bed is generally not recommended. One huge benefit of the solo 401k is the ability for high income earners to make Roth contributions when they would otherwise be limited based on their income. IRS publication 4222 says 401k plans may permit employees to make after-tax contributions through salary deduction. These designated Roth contributions, as well as gains and losses, are accounted for separately from pre-tax contributions. However, designated Roth contributions are treated the same as pre-tax contributions for most aspects of plan operations, such as contribution limits. A 401k plan may allow participants to transfer certain amounts in the plan to their designated Roth account in the plan. This doesn't explain necessarily the intricacies and details of how to execute a Roth conversion inside your 401k or how to do a payroll deduction to the 401k Roth plan. So make sure that you consult with either OTA Tax Pros or your tax preparer to make sure that this is being properly done if that's something that you're using your 401k for. Because Roth and pre-tax funds need to be accounted for separately, they should be kept in separate checking or brokerage accounts. Whether Roth or pre-tax, the accounts and funds are still owned under the name and the EIN, the employer identification number, of the 401k. To convert pre-tax funds to a Roth account in the name of the plan, it's as simple as working with your account trustee to make the conversion. Just make sure that the trustee reports the conversion on a 1099-R before February 1st of the following year, so this can be properly reported on your taxes. For spouses who are joint owners with high incomes, they could make Roth contributions up to $124,000 per year. Of course, if your income is that high, it may be recommendable to make pre-tax contributions instead. Let's take a look at this scenario where Tom has a SEP IRA and a normal traditional IRA that he wants to roll into his 401k. He initially does a rollover and deposits the funds into a checking account with Chase, and later trades options at TradeStation, all in the name of the 401k. At the end of the following year, after having losses from trading options and receiving a smaller bonus from his job than expected, Tom decides to do a Roth conversion. He works with a trustee to transfer the funds, withhold taxes, and later trades equities and gets a non-recourse loan to purchase an apartment complex. Everything is still owned by the 401k. Lastly, even though Tom has an existing Roth IRA, the funds are stuck since he cannot roll a Roth IRA into anything other than another Roth IRA. One of the benefits of having your funds and assets in the Roth 401k plan is that it would not be subject to required minimum distributions or RMDs when you turn 70 and a half or when you're no longer working. Of course, there's a lot more to this than I'm going into right now. As they say, the devil is in the details. We are more than happy to do a consultation with you if you have questions. Our arena where we really show our value is in our advisory, where we get into the nuts and bolts and help our clients build out these plans, because until it happens, it's just a really nifty drawing. Let's talk about joint spousal contributions. Your solo 401k, which is sponsored by the business, covers both spouses provided they are both owners of the sponsoring business. Ideally, there should be separate bank and brokerage accounts to separately account for each spouse's funds. It may also be prudent to open separate checking accounts. These same rules might also apply if you have a qualifying child who could also participate in the plan. However, those details get very convoluted and ambiguous very quickly, so make sure you talk to a tax professional. Continuing with the previous diagram, before Tom decided to do a Roth conversion, he hired his wife, Holly, and made her a part owner of the business to help with miscellaneous office tasks and bookkeeping. Holly decides to roll over her 401k from her previous employer into the solo 401k checking account which was set up for her. She transfers some funds to TradeStation and FXCM to trade options and Forex. Her previous employer also allowed her to contribute to a Roth 401k, which she rolled into the solo 401k and transferred the funds into a designated Roth account at TradeStation to trade equities. Just as we saw in the previous example, Holly's Roth IRA cannot go anywhere. It can only be rolled over into another Roth IRA. Later, after doing Roth conversions, the 401k purchases an apartment complex using a non-recourse loan and pulling equal amounts from both Tom and Holly's Roth checking accounts to pay for a down payment. So it's as simple as it looks. Okay, that's a lie, but now the 401k is beginning to look very similar to professionally managed pension funds that use hedges and real estate-backed securities to provide cash flow for retirement payments. While, of course, we can't tell you where to put your money, if you know what you want, we can help you build it. I know I'm moving through this content quickly. Chances are you have questions, but thank goodness this is recorded so you can stop, rewind, and rewatch the part that you wanted to pay attention to. But jumping right into the next and last advanced technique that I wanted to cover for solo 401ks are participant loans. The following qualified retirement plans allow participants to take participant loans. This list includes 401 plans, 401A, 401ks, 403As, 403B, and 457Bs, along with defined benefit pension plans. It is up to the employer usually to determine whether to allow loans and what terms are permissible. So if you're still employed, double check with your employer what they allow you to do with your retirement plan. In general, a retirement plan participant can take a tax and penalty-free loan up to $50,000 or 50%, whichever is less, and repay it to their plan over 5 years, usually in the form of a payroll deduction. Interest is required to be paid, usually LIBOR plus 1%. That can range from 2.25 to 4.1%, but you can check the current LIBOR rates. But the interest is paid back to your plan, so you're not paying anyone else to take this participant loan. The loan can be used for any purpose. If the loan is used as a down payment, however, there is a special exception that the loan period can be extended out to 15 years. It's also possible to refinance loans. However, the rules are complex and strict. Any late payments or default on paying back the loans to the plan may not only result in a taxable distribution, but can also result in penalties to either the 401k plan or to yourself. So always talk to both your plan administrator and your tax advisor to make sure you understand the details before you take out a participant loan. Piggybacking off our continuing scenario, Tom and Holly each have $100,000 in their own 401k accounts. Tom did not have much money available when he first started his business, so he put all his expenses on his credit card. So Tom takes a 5-year loan out for $50,000 to pay off his credit cards and to fund his business accounts, which would give him enough capital to invest, trade, or to just operate the business. Per his loan agreement, payments are made quarterly, and Tom takes the profits from his businesses to pay back his loan to the 401k. Holly, who has always been very real estate minded, found a great deal on a house, but since her and her husband's finances are stretched thin, she doesn't have enough money for a down payment. She decides to take a $50,000 loan out from her 401k, and both Holly and Tom take an additional $10,000 out from each of their own Roth IRAs. Not only is there no penalty on the money withdrawn from the Roth IRAs, but Holly's 401k loan can be paid back over 15 years. Let's do some math. The $326 monthly payment is almost exactly what the PMI or private mortgage insurance would have been for not having 20% down payment, but rather than paying PMI, she gets to keep her money because she's paying the money and the interest back to her own 401k. Holly then turns around, rents out their old house, uses part of the profits to pay back the loan, and saves $58,680 by not having to pay mortgage insurance, or PMI, during that period. So as you can see, between having participant loans, spousal joint contributions, and both pre-tax and Roth after-tax funds, so as you can see, the self-directed solo 401k has incredibly powerful benefits and features, which can result in saving hundreds of thousands of dollars of taxes over your lifetime. Definitely consider the benefits of switching over whatever retirement plans you have into a solo 401k that you can self-direct, and then work with a tax advisor that you trust and know is competent in these topics to make sure you can put together a plan that's going to save you taxes and reduce your risks moving forward. Now, here's my question for you. Can your current 401k do all that? Thanks for watching this month's special topic monthly webinar. These webinars are our gift to you and are a complimentary part of our services. If you have any topics to suggest, please let us know. Knowledge is power. We want to make sure that the right information is out there and available. If you have any suggestions, let us know, and you can email us or call us. You should also be able to access these webinars from MyOTA. If you have any questions or would like to schedule a complimentary consultation, reach out to us. Mike Latias is our Director of Tax Services. Again, my name is Thomas Jones. I'm the tax manager here. Our phone number is 855-682-7767, and you can either email us at info@otataxpros.com, or you can also visit our website at otataxpros.com.